Right, everybody. Wanted to just take a little bit of time to talk about these other property and liability coverages that we have in the that show up. They're not part of the homeowner's policy, but they're coverages that we need to be aware of. One second here. Let me just double check my toolbar. Make sure. Okay, look at that. Hey, everything seems to be working. Fantastic. That's what you get when you switch software midstream. Okay, so wanted to talk about these extra coverages, and they're kind of varied, they're kind of diverse, and they don't really necessarily fit anywhere very well, but they seem to fit best here when we're done talking about the homeowner's policy, talking about some of the other coverages that are going to turn up when we talk about property and liability. So let me go ahead and get this started here. So we want to talk about these additional coverages here. Hey there. So we got to talk about inland marine floaters. We've hinted at these before, but we haven't used that term. We want to talk about flood insurance. Remember, flood is a peril that is excluded in the homeowner's policy. You can get flood coverage, but you won't be able to get it on the private market. If you have flood coverage, it's most likely through the National Flood Insurance Program, which is a government subsidized program. Then we have to talk about title insurance. That shows up when you go to buy a house, or really any piece of property, but for most of us, it ends up being a home. And then finally, we want to talk about the personal umbrella policy and what that looks like. Okay, so of those four topics, the first one is inland marine floaters. So I wanted to talk about that first. So here's the idea. This is a separate insurance policy for a specific piece of property. And the idea here is that this is property that is probably moved about fairly frequently. And the most common one is going to be an article of jewelry, a wedding ring, an engagement ring, something like that, something fairly valuable, fairly small. We're going to cover it with a separate policy. And the terminology is a little confusing if you don't understand what's going on here. When we talk about marine insurance, we're talking about insurance for items that are moved around, either inland, over land, or ocean marine is a line of insurance that we write, and that covers goods that are shipped over the ocean. So yeah, you've got cars being manufactured in Japan. They're going to be sold in the U.S. while they're on their ocean journey. They need to be insured. We use ocean marine insurance for that. Inland marine insurance we use to handle goods that are being transported over land. So one category would be cargo truck. So things that are shipped by semi, we're covering with inland marine insurance. A floater is a policy that covers one particular item. And so here, that's where in the personal realm, it comes into play. Sometimes we have things like furs or jewelries or camera or musical instruments, valuable things that are getting moved from one place to another. And because they're being moved, they have a higher than average chance of loss in some dimensions, theft being a big one. What we're going to get, okay, so we've talked about, well, what if you had valuable jewelry? How could you insure that? We've talked about scheduling the item, right? You can insure it separately within the homeowner's policy, and that will give you higher limits, but you're still under personal property in the homeowner's policy. So you have named perils coverage, and then you're limited to the actual cash value of the item. And in the case of jewelry, we only had that low limit for theft losses anyway. So all scheduling does is it gives you higher limits, but you're still stuck with only named perils coverage. When you insure separately, now we move to open perils coverage. And in the industry, they'll call that all risks coverage. So now everything is covered unless it's excluded. So your coverage gets a lot broader. The other thing that happens is now we're going to move to a valued policy. And that just means ahead of time, we're going to agree what is going to be paid in the event that there's a loss. So we're not going to use actual cash value anymore. We're just going to say, no, we've valued this engagement ring at $5,000. And if you lose it, that's what's going to be paid. And again, it's all risks. Everything's covered unless it's excluded. So if there's damage to it, as long as it's not excluded, it'll be covered. So this is broader coverage than what we had in the homeowner's policy. And now we're also going to have higher coverage amounts available to us. In addition, there's usually no deductible because we're just talking about one piece of equipment. So the idea of a small loss is less likely, especially because a lot of these losses are going to be theft. So there's typically no deductible here. So there's some huge advantages to insuring this item separately. And again, the most common one is going to be a wedding ring or an engagement ring. So if you keep it insured under the homeowner's policy and schedule it, then you can get higher limits, but you're still stuck with ACV, you're still stuck with named perils. If you insure separately through an inland marine floater, then you're going to be able to have open perils coverage and higher limits, agreed value at the beginning. A valued policy will be able to say this is how much is paid in the event of a loss. And again, no deductible. So certain items that are valuable that are being moved from one place to another, a floater policy might make a lot of sense. And that's something that a good agent will be on top of, and they'll be asking you questions about. Just like your personal property in the homeowner's policy, your property is covered anywhere in the world. So that does not change. And so that's an advantage as well, although it's one you already had. Okay, second item, completely different topic, shifting gears entirely. Want to talk about the National Flood Insurance Program. So remember, flood is not privately insurable because you've got a massive adverse selection problem. The only people who want to buy flood insurance are people who think that they're more likely than average to flood. And we know this based on how close are you to water and how high is your property. Those things really influence whether or not your property will flood. And likewise, they influence your thoughts on whether or not you want to buy flood insurance. So it's hard to spread the risk because it's highly predictable who's going to suffer the losses. We have massive adverse selection here. It's only the people who are going to flood who are interested in buying flood insurance. And for that reason, the private market can't use the insurance mechanism to spread the risk. So we do have a need for flood insurance, and the government is the one that provides it. The private insurance companies sell it, and they service the policies, and they adjust the losses. But the actual entity that's on the hook for paying the losses is the federal government. And so they've said, if you want to participate in the federal flood insurance program, Community of Muncie, here is what you must do. You have to develop flood control plans, and you have to have some land use restrictions. So one thing that happens back in the southern Minnesota, where our family business was located, we had one area that was right along a riverbank, and they used to have houses there, but they ended up developing that property into a park. So tore all the houses down and made it into a park because of the flood risk. That was land use restrictions. They said, look, if you're a property owner, you cannot build right along the banks of the river because we know you're going to flood. So one of our rules that we have is if you own property here, you're going to have to sell it to us and we'll turn it into a park. And that's what they did. So yeah, that every other year it floods, but it's a park. So, for a while there, the playground equipment might be under some water, but eventually that yields back and it's fine and it's usable in that form. That's an example of land use restrictions. So a community that wants to be able to participate in the flood insurance program, you would have to develop some of these low-lying areas. What do we do with this land to minimize damages? And I think it's something like all but 7 Indiana counties participate in the National Flood Insurance Program. And do you know what feature those 7 counties that don't participate share? Extremely high elevation relative to the rest of the state. So it's perfectly understandable. It makes sense. They don't need it. So they haven't bothered to participate. Everybody else, though, has had to develop a flood control plan and some land use restrictions to try to prevent damage. Usually flood insurance, the way it comes up is when you go to buy a house, they'll do a flood search. So this is one of the many administrative things you have to do when you buy a house. They'll look to see where it's located. We've got all of the U.S. mapped out in terms of flood likelihood. So we have flood maps. And what they'll say is, if you're purchasing a home within the 100-year floodplain, you must buy flood insurance or you won't be able to get a mortgage, right? Nobody will lend you money to build a house within the 100-year floodplain or buy a house within the 100-year floodplain because of the potential that the house could flood. And that's, when you think about it, when you get a mortgage, if your house gets destroyed, yeah, that sounds like your problem. And partly it is. It's also the bank's problem because they have lent you the money for the house. They're the ones who really own the house. And so they're going to say, all right, if you're in this 100-year floodplain And colloquially, it's not technically correct, but you could say that the average chance of flooding in any given year is 1 in 100. And so they call that the 100-year floodplain. And then they have areas within that and areas without that. If you're outside of that, you won't have to buy flood insurance unless you choose. Inside of that, to get a mortgage, you'll have to buy flood insurance. And that's how almost all flood insurance is purchased. People generally don't buy it unless they have to. So if you're buying a property within the 100-year floodplain with your own money, it's your money. You don't have to buy flood insurance. You're taking the risk. If you're okay with that, that's up to you. But if you're going to use somebody else's money, they're going to make you do it. And so most of the people who've bought flood insurance, that's how it's come up. Here's what you don't know. Half of the flooding that occurs happens outside of that 100-year floodplain. So basically half of the people that suffer flood loss have flood insurance and half of them don't. And as I've said before, the time to realize that flood is not covered is not when your house is floating down the river. That's not real helpful. You need to know that ahead of time. And unless you're an expert on homeowners insurance, I don't know how you would know that. So we really rely on the agents to explain to their customers about flood coverage and how they can get it. So yeah, we have massive adverse selection. We have a problem with bailout and repeated losses. So people have this idea that if they suffer a natural catastrophe, that the government will bail them out and rebuild their home. When they do, that tends to come in the form of loans, not grants, meaning that it has to be paid back. So yeah, you'll get some assistance, but it's not free. And people usually don't realize that until they've already gone through the catastrophe and they've already been financially impacted. And that's a huge problem. We have these unmet expectations that are out there. People see the government assisting and they assume all that help is free. Most of the time it is not. And so that's a problem. With flood insurance, there was one property that they talk about that in 25 years flooded 22 times. And yeah, the federal flood insurance program rebuilt that house 22 times in 25 years. That's not really wise. So there are some programs about trying to buy out some properties. The most frequently flooded properties, can we buy these properties out so at least we don't have to fix them again and again and again? That is a big problem with the flood insurance program, is repeated loss properties. And then again, coupled with this belief that the government will fully pay your losses even if you don't have insurance. And again, that is generally not the case, at least not with money that doesn't have to be repaid. So if your home is in that 100-year floodplain, again, a lot of this is automatically determined. I mean, if you're trying to buy a house within a 100-year floodplain, 99% of us have to use a mortgage to do that, and the mortgage lender is going to make you buy it. End of story. There's not a lot. If you're outside of that, that's something you still might want to consider if flood losses are possible. And again, you're relying on your agent to help you with this. Shifting gears again, I want to talk a little bit about title insurance. And again, this is going to come up when you buy a piece of property. And for most of us, that's going to be a home. So it protects you against defects in title. How do you know that the person who sold you this piece of property actually owns it? Right? I mean, they can say, oh yeah, the property is yours out to where we've built this fence. How do you know that's accurate? Well, it's possible that it's not. Maybe there's been some errors in the property transfers over hundreds of years, and we finally untangle it and we realize, wow, the property you thought was yours really isn't. It belongs to somebody else. Well, now you've got a problem because you've already paid for it, perhaps long ago. In Florida, where I started teaching, the premiums were regulated. So you buy title insurance as part of your home purchase. And the way it works is you only pay a premium once, and it's good for the entire period of time that you own the home, and it protects you against what if what you thought you bought, you really don't have title to. Well, we can protect your purchase value of the property with title insurance. And in Florida, it was a really neat way to do it. I mean, if your house was a $150,000 house, this is what you paid for title insurance. It was on a schedule, and every title insurance company had to charge the same prices. That's not the case in most states. Most states, it's competitive, and different title insurance companies will charge different premiums. The loss rates here are extremely low, and so the insurance coverage is relatively inexpensive. And again, you only pay one premium for the entire time that you own the property. Again, your mortgage lender is going to require you to buy title insurance. They will not loan you money to buy a house unless you're going to buy title insurance. So this is part of the closing. This is one of the fees that you're going to pay is title insurance. Some of the interesting things that happen here with title insurance are the ones that are listed here, and I'll get into those in a second. Okay, so one issue is repeated sales of the same property. And that's one of our problems because we said you only pay one title insurance premium and it's good for the entire period of ownership, right? So yeah, if you buy this one property and you hold it for 30 years, you pay one premium and that's it. If you're buying a new house every year, you're going to pay title insurance every single time you buy a new house. And that's not really how most insurance works. Most insurance covers you for a specific period of time, 1 year, and then you have to renew policies from there. The other problem that you're going to have is you buy the house and you hold it for 30 years, and the value has increased over those 30 years, but your limit of title insurance has not. And so that's a problem, that your limit is not protected from inflation. So again, that's something that you're going to come across when you buy a house. The last topic I wanted to talk about here is the umbrella policy. I've mentioned it before. But what an umbrella policy does is it gives you a massive amount of liability coverage. So it's protecting you against the idea that you could get sued for a huge amount of money. Remember, in the homeowner's policy, we have $100,000 in coverage. The umbrella policy is going to sit above that. It's also going to sit above your auto liability coverage. And we haven't talked about that yet. But it's going to cover both homeowners and auto. It'll sit above and it'll provide a massive amount of coverage against catastrophic lawsuits or judgments. So the idea that you might get sued for $1 million, well, if you got $100,000 in coverage, that's a pretty big gap. It's unlikely you're going to get sued for that amount of money. And because it's so unlikely, it makes this policy really, really inexpensive. So this is excess liability. Remember, we have primary and excess insurance. Well, your primary layer is going to either be provided by your homeowner's policy or your auto policy. And then the excess, this umbrella, sits above both of those. So they're going to make you boost both of those levels of coverage. It's normal for them to say you have to have $300,000 on the homeowner side, and you have to have at least $250,000 on the auto side before you can buy an umbrella policy that sits above it. And then it's normal for people to buy $1 million in excess coverage that sits above the $300,000 on the homeowner side, the $250,000 on the auto side. So if you get sued for $1 million, now you got coverage to handle that. This is really, really broad coverage. We didn't spend much time talking about the personal injury losses, things like libel, slander, false arrest. You can read more about that in the textbook if you want. But this is really broad coverage here. And there aren't many things you can be sued for that an umbrella policy won't protect you against. We do have a deductible here, but it only applies for losses that are not covered by the underlying contract. And so that's going to be these personal injury things like libel and slander and false arrest. And there's a few other examples that come up. They're narrow, they're rare. But if you do get sued for one of those, then there is a small deductible you'll have to satisfy that they call a self-insured retention. Otherwise, if it's covered by the underlying, then we don't worry about deductibles, just like normally in Section 2 and in liability coverage. And in what we're going to see in auto liability coverage, there is no deductible. So basically what we're doing is we're buying a huge amount of liability coverage. And because it's so rare, it's cheap. Usually $150 a year will get you $1 million in excess liability coverage because we're not going to use it unless we blow through our underlying limits, which are going to be $300,000 or $250,000. So this is only going to be used if we get sued for more than $250,000 and less than $1 million, right? So that's extremely unlikely. You can get this huge layer of coverage for about $150 a year. And when you get to the point where you have $1 million in assets to protect, that's when it becomes a really smart buy, right? Because otherwise you're just exposed. Man, if I can protect $1 million in assets for $100, yeah, I'm going to do that. That's extraordinarily cheap because what if I get in a car accident where somebody else is seriously hurt? That's just bad luck. They call it accidents. I didn't do it on purpose. But if I have the bad luck to get into an accident and run into an emergency room doctor and I injure them to the point where they can't work for a few years, that could be $1 million loss. And that's something that I will be on the hook for if I don't have enough coverage. So this is something that when people have assets to protect, we always recommend. And I hope that makes sense. So it's a massive amount of liability coverage. That's what the personal umbrella policy is doing for you. Okay, that's pretty good for those 4 topics. That's just a tiny piece of what's in that chapter 24 for you. The questions on the review sheet can show you that we're not going into depth on these topics, but that's what you need to know to be ready for an exam on these topics anyway. Thanks a lot, you guys. We'll go from there.